If companies are making record profits, why are so many people losing their jobs? On the surface, layoffs are supposed to signal trouble. But in today's economy, layoffs often happen when companies are doing well, not when they're struggling. To understand why, you have to look at how modern corporations are actually measured and rewarded. Public companies are not optimized for employment. They are optimized for efficiency, margins, and stock price performance. Revenue growth alone is no longer enough. What matters is how much profit a company generates per dollar spent, and labor is one of the largest and most visible costs on the balance sheet. When investors evaluate a company, they don't ask how many people it employs. They ask how fast margins are expanding, how operating expenses compare to revenue growth, and whether management can scale output without scaling headcount. Reducing payroll is one of the fastest ways to improve those metrics. This is why you see companies like Meta or Microsoft announcing layoffs shortly after reporting strong earnings. The layoffs are not a sign of collapse. They are a signal to Wall Street that management is serious about cost discipline and long-term profitability. There is also a timing effect. During periods of cheap money, companies tend to overhire. When interest rates rise and capital becomes more expensive, investors shift focus from growth at any cost to efficiency and returns. Even profitable teams become vulnerable if they don't directly support revenue or strategic priorities. Productivity is another factor. Advances in automation, AI, and internal tooling allow companies to produce more output with fewer people. When a single engineer or analyst can now do the work of multiple people, the economic incentive to reduce headcount becomes obvious. From a business perspective, keeping excess labor is viewed as inefficiency, not stability. Executive compensation also plays a role. Bonuses and stock awards are often tied to margin targets, earnings per share, and stock performance. Layoffs can boost all three in the short term. This creates a structural incentive to reduce labor costs even when the company is healthy. Importantly, layoffs are not evenly distributed. They tend to hit support functions, experimental projects, and roles with indirect revenue impact first. Core profit centers are usually protected. This is why layoffs often feel sudden and disconnected from individual performance. They are portfolio decisions, not personal ones. From an investor's point of view, layoffs can be interpreted as strength. A company that cuts costs proactively is seen as disciplined and future-focused. That's why stock prices often rise after layoff announcements, even though the human impact is severe. For workers, the lesson is uncomfortable but important. Job security is no longer tied to company profitability. It's tied to relevance, leverage, and adaptability. Being employed by a successful company does not guarantee safety if your role is not directly aligned with its evolving strategy. For investors, layoffs signal a shift in priorities. They often indicate a move from expansion to optimization. Understanding this helps explain why markets react positively to news that feels negative in real life. Layoffs today are not just about survival. They are about optimization in a system that rewards efficiency above all else. Once you understand the incentives, the pattern becomes clear. If this explanation helped you see corporate decisions more clearly, follow Real Business Today for daily breakdowns of business, finance, and how money actually moves behind the scenes.